invest or pay off debt. Which is the better choice? The decision between investing and paying off debt is a common dilemma. You may wonder if it's more beneficial to use your money to pay down debt or invest it to earn higher returns. Ultimately, it depends on your financial goals and risk tolerance. Paying off debt can provide peace of mind and reduce financial stress, while investing can potentially lead to exponential growth for your future. Assess your priorities and consider both options carefully before making a choice. Indeed, both options have their merits, and the impact of this straightforward decision can be significant, depending on your circumstances. Choosing between them could lead to a substantial difference in your financial future, potentially amounting to hundreds of thousands or even millions of dollars. By examining the advantages and disadvantages of each option, you can make an informed choice that may determine whether you end up financially strained or achieve true financial freedom. Welcome to the Money Tree channel, where I strive to educate people about money, personal finance, and investing. If you want to enhance your financial future, consider subscribing to the channel and giving this video a thumbs up if you find it beneficial. Prior to choosing between paying off debt or investing, it's crucial to establish a solid financial foundation. This involves creating an emergency fund dedicated exclusively to unexpected expenses. Without this safety net, both paying off debt and investing become risky, because a single financial emergency could derail your progress. Aim to save 3 to 6 months' worth of expenses before making further financial decisions to ensure greater stability and security. One of the most rewarding aspects of reducing debt and achieving debt-free status is the newfound financial flexibility in your budget. When you have multiple debt payments draining your account, it becomes challenging to prioritize personal savings. Living paycheck to paycheck and barely getting by can be discouraging, as it seems like you're working solely to cover bills without making substantial financial progress, especially when a significant portion of those payments goes towards interest. However, once you've paid off all loans, it will feel like a significant raise, as a larger percentage of your paycheck becomes yours to keep. Being debt-free simplifies increasing retirement contributions, potentially enabling you to retire at a younger age with greater financial security. On the other hand, some individuals opt to invest their surplus funds before achieving complete debt freedom. They do so because the returns earned from investments have the potential to far surpass the interest rates on their debts, leading to significant profits. Why pay off debt with a 5% interest rate when you could potentially earn 10% or more through investments? Waiting to invest until after becoming debt-free might take several years, causing you to miss out on substantial compound interest that could snowball your wealth to a whole new level. The primary determinant in choosing between aggressively paying down debt or investing surplus funds is risk. Paying off loans offers a guaranteed return, since eliminating a debt with a 30% interest is akin to earning a 30% return on your money with zero risk. On the other hand, investing always carries some level of risk. It is possible to achieve a 10% or higher return by investing in the S&P 500. Historically, the S&P 500 has averaged over 10% per year since its inception. However, there have been periods of negative returns, such as in 2000, 2001, 2002, and 2008. Over the long term, the likelihood of making a profit is favorable, but it's essential to remember that returns are not guaranteed, and to factor this into your financial strategy. Consider this practical real-life scenario that compares paying down debt to investing in the stock market. Imagine you have a $350,000 mortgage with a 30-year term and a reasonable 4% interest rate, leading to a monthly payment of $1,671. Now, you have an additional $1,000 in your budget, and you're torn between using it to pay down the mortgage or investing it. Ensure which option will yield better results at the end of the 30-year loan period. It's essential to weigh the potential outcomes carefully. Scenario 1. Focusing on paying down the mortgage allows you to become debt-free in 14 years and 5 months instead of the full 30-year term. By paying an extra $1,000 per month towards the principal, you end up paying only $110,799 in interest over the life of the loan. Once the mortgage is paid off, you can redirect your efforts and invest not just the extra $1,000 per month, but also the previous mortgage payment, totaling $2,671 per month. Over the remaining 15 years and 7 months, this investment approach would result in a total of $1,203,916. To determine your final outcome, subtract the total interest paid $110,799 from the amount invested $1,203,916, leaving you with a total of $1,093,117 accumulated by the end of the 30-year period. In summary, this equation represents the sum of your investments minus the amount of interest you paid. In Scenario 2, the approach is to make only the minimum payment on the mortgage while investing the extra $1,000 each month. By opting for the minimum payment, you end up paying a substantial $251,544 in interest over the 30-year period, considerably more than in the first scenario. However, if you choose to invest the $1,000 per month in the S&P 500, assuming an average return of 10%, it will grow to $2,171,000 after 30 years. When you deduct the interest paid $251,544 from the total invested amount $2,171,000, you'll be left with $1,919,456. The difference between Scenario 2's total and Scenario 1's total amounts to $826,339. By investing the extra $1,000 per month in the S&P 500 instead of paying down the mortgage, you could have over $826,000 more at the end of the 30-year period, thanks to the power of compounding over many years. This significant amount could potentially be the deciding factor between being able to retire or having to work for many more years. Certainly, it's essential to recognize that this analysis doesn't account for the risks associated with investing in the stock market and assumes an average return, which is reasonable over an extended period. A significant advantage of having a 30-year mortgage is the influence of inflation. While the mortgage payment remains a fixed dollar amount throughout the loan term, the value of the dollar diminishes over time. As a result, you can repay the loan with dollars that hold less value than they did initially. Assuming an average inflation rate of 4%, the dollar's value erodes approximately every 18 years. After this period, your mortgage payment will be only half of what it was when you first took out the loan. Simultaneously, you have the opportunity to invest in assets that can keep pace with or even exceed the rate of inflation, offering you the best of both worlds. When contemplating the choice between paying off debt or investing, a mortgage stands out as an extreme example, and 2 reasons contribute to this distinction. Firstly, mortgages often offer very low interest rates, perhaps being the most favorable borrowing option available, with the average mortgage rate around 3% in 2021. Even at the current near 5% rate, it remains remarkably close to the rate of inflation, implying that borrowing money through a mortgage comes at a minimal cost. This attractive aspect makes mortgages desirable for certain investors who find it beneficial to leverage these low-interest loans. The second reason is that mortgages are typically long-term loans, often spanning 3 decades. With such extended loan terms, the disparity between choosing to pay down the loan or invest surplus funds becomes significantly more substantial and warrants careful analysis. Deciding whether to pay down debt is not as straightforward as it may initially seem, and several factors need consideration. One significant advantage is improved cash flow, which can create more room in your budget. This aspect is particularly vital for older investors preparing for retirement. Prioritizing cash flow becomes your primary concern, rather than solely focusing on which strategy will yield more money in the distant future after 30 years. Risk is another crucial aspect to take into account, and it's essential to comprehend its implications when choosing a strategy. In general, prioritizing the repayment of high-interest loans while utilizing low-interest ones can yield the most significant returns over the long run. Moreover, it may be prudent to consider a combination of both approaches, gradually paying down debt while concurrently making investments using extra income. This balanced approach can help you achieve financial progress and manage risk effectively. This topic often elicits strong opinions from people, but the numbers provide an accurate portrayal of each scenario. It's your responsibility to evaluate the risk and potential rewards to determine what aligns best with your financial goals. Take into account all the pros and cons associated with both options before making an informed decision. By thoroughly considering all factors, you can arrive at a choice that suits your individual circumstances and aspirations. In summary, whether to invest or pay off debt is a multifaceted decision influenced by personal circumstances, risk tolerance, and financial objectives. It is crucial to build a strong financial foundation, which includes having an emergency fund, before making such choices. While paying down high-interest debts ensures a certain return, investing presents the opportunity for higher returns but involves market risks. Striking a balance by considering both debt reduction and investment strategies may prove to be the wisest approach in pursuing long-term financial prosperity. Be sure to seek advice from a financial advisor or professional who can customize a strategy to fit your specific situation and objectives. Their expertise will help ensure your financial plan is well suited to your needs and goals.